I guess before we get started with the actual kind of podcast format, so as most of you guys know, you were invited either by someone on our team or maybe saw the advertisement on Eventbrite or Meetup. We're brokers, we're an investment team, talk to a lot of, we have some extra seats. There we go. So we talk to investors obviously every day, and a common question and a pain point for a lot of investors these days is to find a 1031 exchange property, right? You might have a property you may have owned for a very long time, you may have inherited something from a family member, you would love to potentially trade it into something better, increase cash flow, get depreciation back, an abundance of reasons, but man, it's hard finding inventory these days, right? Something that's worth getting into. You don't want to sell your investment property you spent all these years stabilizing to now buy something that you're going to have to stabilize again and get a similar return. So that doesn't make sense, right? So one of the solutions that we have come across is a DST. I think it is a great option, in my personal opinion. There's obviously pros and cons with everything, and that's why I've invited Kevin and Mitch to speak on it and answer questions and everything. But in my opinion, one of the hardest things about investing in a DST is that you're essentially investing into some company that is usually in a bigger market, SoCal or the Bay Area. You know nothing about them, you have no personal relationships, no ties or anything, and you're potentially investing a bunch of money with them, right? And these guys are local companies down the street in Clovis. So to my knowledge, I think only DST sponsors locally.
Yep.
So I think that's a huge benefit that you guys can go down to their office in Clovis, schedule a meeting anytime you want, learn more about the investment. So what I'd like to do is just kind of a brief, like I said, 15, 20 minute, just kind of interview style, just so we could record some content, and then we'll just open it up and you guys can ask any kind of questions you guys want. Sounds good? Let's get started. If Chris is ready, we'll get started.
Yep, go ahead.
All right, so first type of podcast format for me of this kind of thing. I know, Kevin, you're a pro, but I guess I want to start off by, come on in. Oh, do we need another chair? That's okay.
No, that's okay.
No, let me get another chair.
This one, ma'am, take this right here.
There's one right here.
Ma'am, Jeff, this one, ma'am, take this one. I'll get one.
So
Oh,
sorry.
you're good.
Take this right here, nice and comfortable. Maybe got the seat one for you. You're quite welcome.
We got another, Howard.
We play Miss Goose Cheers. Got one?
Yep.
Oh, thank you very much. Here, let me get out of the frame of content here. You sit in that corner. Thank you very much.
All right. So let me just start off by first just thanking everyone for coming. Obviously, we, all have busy lives, and this is kind of prime business hours, but I purposely scheduled it for this time because I felt that this is the time where if this information was valuable for you, you make the time to come out and learn more about it, right? So our first podcast style, video content. Hopefully we can make it as natural as possible, but Kevin's actually the pro at it. Kevin's got over 100,000 subscribers, so feel free to give me some guidance, right? Because we'll edit the stuff out that doesn't work. But real quick intro, Jeff Kim, multifamily investment specialist, broker associate here at Colliers. Also started an investment team that we call the JKRE Investment Group. I've asked Kevin and Mitch to join us to tell us a little bit about Ideal Capital Group, a little bit about themselves. And I guess let me just start off with, for those who may not know you yet, you guys can speak a little bit about Ideal Capital Group and your roles with the company.
Yeah, absolutely. So thanks, Jeff, for having us. It's exciting to be part of the first podcast. So my name is Kevin Conway. This is Mitch Souza. We're with Ideal Capital Group, and our firm focuses on one thing, which is acquiring multifamily housing. That's apartment buildings. We do so in a variety of different ways, but the commonality is that we put our own capital in every single deal that we do in a material way. And so if you're invested with us, you're not just invested in a deal that our company put together, but in an asset in which I'm personally involved along with my business partner right alongside of you. Our focus is multifamily. That's all we're ever going to do. That's all we ever have done. We have over 1,200 individual investors nationwide. We place money for large institutional groups such as Transamerica and others. We have a great track record, and as was mentioned previous to the start of this podcast, we are a group local to the Fresno and Clovis area, and our door is always open for those that live here and for those that don't. It's important for us to be transparent, honest, and have an open door, and that's the philosophy we live by.
Sounds great. And Mitch, a little quick intro?
Yeah, so Kevin's managing director of Ideal. I oversee acquisitions, which is obviously going out and finding the properties we're going to buy and invest in. So we cover pretty much the entirety of the country. We're invested in 9 states right now, mostly West Coast and the Southwest, but expanding eastward. So any questions you have about kind of property-related investments, either that's state of the market, return projections, kind of what we're underwriting, what we're seeing, and then any kind of equity raising, anything sort of kind of on the investor side as well, kind of runs through myself and our team. So been with Ideal for almost 6 years now, and excited to be here.
Sounds great. And for those unfamiliar with a DST and how it functions within a 1031 exchange, would you guys mind talking about that a little bit?
Absolutely. So a DST is a product that is especially valuable for those looking to step out of the day-to-day management of their properties, but do so in a tax-advantaged way. So in 2004, the IRS declared that DSTs were considered like-kind replacement property for the purposes of 1031 exchanges, which gave investors an avenue to take their assets that have accumulated a lot of equity, sell them, and within the exact same rules as any other 1031 exchange, place that capital within this product type. And as a result of that, the investor will have the potential for monthly cash flow, professional institutional quality ownership on a fractional basis of real estate, and also be able to get investor tax reporting every single year, potentially increased basis, which may help with your depreciation schedule, as well as the continuation of your 1031 exchange upon the liquidation of the DST down the road. It's a tool that is valuable for those looking to have it be their primary exchange vehicle or a backup option in your exchange timeline. So, for example, suppose you're on the fence of selling a property because you're concerned about what are you going to do with that capital. You don't want to pay taxes on it. Well, you could identify a DST, which is a ready-made product owning a specific piece of real estate or pieces of real estate, which produces actual cash and has actual financials and is ready-made. And you could identify that as a backup option in your exchange, as a primary option, or an option for which you put part of your exchange into it.
So I have a list of questions, but as I'm going through it, I think most of them actually get covered in this presentation. So would you mind just kind of going through the slides?
Absolutely. So I think we covered a little bit of this, but as background to who we are, we have several $1 billion under management. We do only one thing, which is apartments, multifamily. We have student housing, we have market rate housing, we have affordable housing, we have seniors housing. But the commonality is if you need a place to live, that's going to be an attractive asset class because that will never change. People need to put their head somewhere. We want to be on the other side of that, collecting rent every month. We have done this a lot. We're active in California, Oregon, Nevada, Utah, Colorado, Texas, Kentucky, Ohio, and potentially more states in the future. We've had a lot of track record of success. What I'm proud most of is that we do what we say we're going to do, and we put our money exactly in the same position as our investors in these deals, which to me is the most important part of any investment that one may do. And so what we look for in a firm when we acquire an asset primarily is for those apartments that are next to what we call large immovable economic drivers. So large economic drivers that aren't going to move in bad times. The good times will take care of themselves. The bad times what we focus on. So in the event of a recession, will people still rent our apartment? Well, one way we could be relatively sure of that is if we're next to those things that'll still be producing jobs and still need employees in bad times. Think universities. You're not going to move Fresno State or Arizona State if the economy gets worse. Hospitals, people don't get less sick because the economy slows down. We want to be next to those things because we're going to provide housing for nurses or doctors or technicians and give ourselves a reasonably high level of success of having occupancy, which is ultimately the driver of income, which is what our investors rely on. We are active across the nation. We have a large pipeline of properties through both brokers and developers directly. There's certain markets that we like more than others. Generally speaking, our DSTs tend to be in so-called red states or red-ish states, more landlord-friendly markets that our investors here in California would prefer their capital being in. I'm sure anyone owning property in California can tell you a story or two about the California rules and regulations they wish didn't exist, and that's why we tend to buy in those other markets. I think we covered a bit about what a Delaware statutory trust is, but I'll focus more on the process side from an investor standpoint. It is a very seamless transition from your sale to being an owner in a proportionate way of a DST. The way that it works is you review the partnership, or it's not a partnership, you review the private placement memorandum and several other investment documents. You sign those documents, and within a day, your accommodator, where your cash sits after your escrow closes, would wire the funds to Ideal, and then you would get your proportionate share of ownership in the DST. Again, it's 1031 eligible, and so you don't recognize gain upon that transaction. And DSTs are pro rata, meaning if you are a 1% owner of the DST because you invested $1 million in a $100 million raise, then you get 1% of the cash flow, 1% of the depreciation, 1% of the upside. The process of completing your exchange is, again, as simple as completing the paperwork and wiring the funds. This makes it more certain than any other avenue that you would if you were to try to buy property on your own, because the property is something that our company acquires first and then raises the money afterwards. It's done, it's dusted, it's certain, and you could be sure that you're going to execute there. Before I continue, should we cover anything or should I?
Oh, we're good.
Okay, great. So some of the benefits of a DST I've already covered, but I'll highlight a couple of them. Excuse me, I'm a little bit under the weather. We buy institutional quality assets, meaning assets that no individual is likely to be able to acquire on their own. These are properties that may be $80, $90, $100 million in purchase price. And like anything in life, economies of scale yields benefits that being bigger is better. So we'll acquire a property that's 300 units. That leads to efficiencies of management, efficiencies of fees and costs and everything else. Not to mention the fact that these assets tend to be in the best of locations versus a Class C property, and it allows investors to have a higher level of confidence in what they're owning. They get a piece of that real estate. DSTs are also not TICs. They're not tenancy in commons, meaning we don't have to have uniformity of decision making amongst the investors. In fact, it's prohibited. We are the trustees of the trust. We make the decisions, which is beneficial for everybody because if you've ever tried to decide amongst your friend group where to go to lunch, that decision is difficult. Now, add in several more investors and millions of dollars, and you can see why that would be a significant problem if it were property. Here with DSTs, we're the experts. We know what we're doing. We decide when to sell, we decide what to buy, and you decide if to invest or not. But ultimately, we're the ones that are going to take that day-to-day ownership of management, which means you don't have to do anything at all except for receive that cash flow and those investor tax documents every year. One of the other benefits is if you own property, you're used to obtaining loans on your own. You're used to providing your financials to the bank, being the personal guarantors of the loans. That doesn't exist in the DST space for investors. We, that is my business partner and myself, by virtue of being trustees of the trust, are the ones that provide our financials, our balance sheet, and our non-recourse carve-out guarantee to the lender to obtain that loan. That means that you get no responsibility on the loan either, but you get allocated your share of loan proceeds to satisfy your exchange. So it's the best of both worlds in my view. Another benefit is that you could diversify in more than one DST because DSTs are like-kind exchange properties. You could put some of your money in our DSTs, some in others. You could spread it amongst the DSTs that we offer or other properties. Or suppose you found an asset that you liked, but you had some leftover money, you could put that into a DST as well, provided that you do it within the 1031 guidelines. And then ultimately, what most investors want is a cash flow. So we do monthly cash distributions via ACH to your investor bank account. You tell us where to send the money, and that's where we're going to push the available cash distribution every month. These assets tend to be on the risk spectrum, slightly lower risk than, suppose, value-add property, about 50% leveraged or less. And so the stability of cash flow tends to be, although isn't guaranteed, tends to be a little bit more certain than perhaps other asset classes. And of course, estate planning benefits are also a big deal. So we acquire the asset, you invest in the DST, we own it for 5 to 7 years, sell it, you could exchange again, or, this isn't too fun, but everybody will do it at some point, die. Your heirs will get stepped up basis on those DST interests. And at the time that we liquidate the DST, you can take that cash and, of course, have the favorable stepped up basis with that as well. And so for us, one of the things that we can do is offer you options. Whether you're on the fence or whether you know you're selling a property, a DST is an option for you to exchange into, and it allows you to have high confidence that you are not going to fail your exchange at the very least. And for most people, for most of our investors, they're extremely pleased to get out of the discussions with tenants, fixing toilets, having insurance calls, having to worry about filling vacancies, and take that passive role, exchange into an institutional quality real estate, and often generate significantly more cash flow and more depreciation than they were getting previously. Evaluating a DST sponsor. This slide is simply, in your journey, we're not the only DST sponsor around. There are others. There's probably 40 to 60 every year that have products out there. Some are better than others. The one differentiator I could say about our firm versus everyone else is that when you talk to anyone else from any other firm, they will never tell you that they're investing a substantial amount in their deals, often because they themselves aren't an owner of the firm, or they simply don't for whatever reason. We are different. We're going down with the ship if it doesn't perform, and we're likewise going to benefit if it goes well because we have our own capital in the deal. Thank you so much. So we co-invest alongside our investors, which to me is the most important differentiator. Of course, we have a long, successful track record. We focus just on multifamily, but ultimately that's the biggest differentiator in my view of us. We also have a great staff, a lot of high professional people that do asset management, construction management, accounting. Mitch runs acquisitions. We've got a lot of smart people that are always available at any time to answer your questions that any investor may have. So before and after your exchange, the typical hold period for a DST may be 5 to 7 years. It typically won't exceed 10 years, and it typically won't be less than 5 years. These assets, the biggest downside is that they're illiquid, meaning If you're looking to buy into this and cash your money out in 6 months, that's not the right product for you, because while you're able to sell your asset, your shares, your DST interests to somebody else, we can't make a market for you. We have too many DSTs. That exposure would be too difficult. And so as a result, the liquidity isn't quite there. I covered a little bit about this before, but you could split your DST investment among different family members. Actually, this is a crucial point. If you have a family partnership or an LLC, without providing legal or tax advice, what I've seen is that you're able to exchange that partnership into the DST, and then after a sufficient period of time, usually 2 years, you could dissolve that partnership, distribute those interests among the interest holders on a non-tax recognition event, and then when the DST sells, subsequent to that, down the road, several years, you and your previous partners could then go your separate ways, which we find as a big benefit to families or partners that have owned real estate for a long time. And as I mentioned, DSTs are a great backup option or primary option for your exchange. We covered a little bit about this, but like I mentioned, we put our own money in every deal. We focus on just multifamily. And so with that, let me cover 2 quick examples of what a DST might look like, because I've done a lot of talking. Now it's time for pictures. So the first one is a property called Centillo. We fully raised this as a DST about 2 years ago. It's an apartment building, 325 units, next to the TSMC plant in Arizona, Taiwan Semiconductor Manufacturing Company. Most of you may have heard of them or maybe not, but are undoubtedly affected by TSMC. They make 90% of the advanced semiconductors or microchips that are found in everything from weapons to iPhones and everything that we use day to day. In other words, they're a fantastic and crucially important company, and we're lucky enough to be able to lease this building that we brought out as a DST exclusively to TSMC's employees. This is the type of institutional asset which we purchased for $108 million and have 150 different investors in, that is representative of the type of DST that we will bring out in the future. So your assets that you own now that you may sell, if any of you own this type of asset, then congratulations. But most of the time, it's unlikely that individuals have access or ownership to real estate that is this quality. However, as an investor in the DST, you have the pro rata ownership of it, which is significant and beneficial. This one's performing very well to date. Of course, anything could happen, but we do monthly distributions out of this asset. This right here is a property. It's actually 2 properties comprised in a DST that we're bringing out called Langham and Essex, and this is situated next to Ohio State University. It's also situated next to their hospital as well, again, fitting the markers of what we look for, large and movable economic drivers. Ohio State's not going anywhere. The hospital is not going anywhere. We like that very much. This asset is extremely nice. It's 258 units or so. And again, it's pretty much full, about 98% occupied as I last recall, distributing cash flow generously to our investors. Now, with all this said, you have to read all the various DST documents before considering an investment. And highly recommend you look into this. And if you want to, we're available at any time for further analysis. So hopefully that was helpful enough.
Definitely. Mitch, you mind sharing a little bit on how you look at a potential deal for Ideal Capital, the underwriting, the due diligence that
Sure.
you and your team does?
Yeah, so I mean, as you can imagine, every building is different from the other, even if they're right next door to each other. A property like this, for example, Langham and Essex, was 2 properties next door to each other. So what we look for, as Kevin talked about, is kind of a couple different things. The main one is you're looking at, a macro environment as well as the micro, right? So macro in this market, for example, is What are the jobs like? What is Ohio State doing? Is Ohio State increasing enrollment? Are they decreasing enrollment? Are jobs, employers coming to the area? Are they leaving the area? So it kind of starts at a macro level before diving into the property level. So at the property level here, like Kevin mentioned, 98% occupancy, a wait list actually formed for people wanting to move in 6 months down the line. Almost unheard of today across the country, especially in markets I'm sure a lot of you guys are aware of. So that's obviously an initial box checked. Occupancy levels are there, demand is there, that looks great. Then when we dive into more of kind of the operational side, this property we're buying directly from the developer. So most developers, more often than not, are not great operators. They're good at coming in, devising the plan, entitling the property, constructing it, and then selling it. They don't want to be the one managing the day-to-day in the weeds. So what happens is on a deal like this, we look at that as more of an opportunity and say, okay, this developer is leaving a lot of money on the table by not operating it efficiently, whether that's with staffing, payroll, insurance, the way they're running, turnover if somebody moves out, might not be enforcing the correct kind of income charges to residents, being a little lackluster. All of those things on a deal like this were checked. And then at the end of the day, what we're looking for is, a market level return based on that kind of risk adjusted profile. So for a deal like this, we're not gonna, kind of how we arrive at a price, let's say, as you guys would all know as investors here, is we're not just picking a number out of thin air and saying, hey, we'll give you, 120 million for this, let's take it. We're coming in and looking at, okay, all of these cash flows in year 1, 2, 3, all the way through the 10-year period. What are we looking at on a risk-adjusted basis today? And so for us in a DST, cash flow is the name of the game. Most people here are interested in that exact figure. If you're exchanging into a deal, or just in general, you're looking for income replacement or investment return in that perspective. So that all kind of factors into why a deal like this makes sense. And so, for example, last year we underwrote over 200 properties and only bought one of those because on the other 199, they didn't check the boxes that I just mentioned. So it's a very finite criteria that we try to nail things down to. And some properties might work on the margin, but we are a group that's not going to squeeze something in just to do a deal. Our goal is, like Kevin mentioned, we're putting our own money into these deals that we do. So we're not going to put something out that doesn't check all of our boxes and it isn't, we take a very sharpshooter approach to the properties that we're underwriting and eventually purchasing.
Yeah, good stuff. If somebody here is interested, but maybe wants to evaluate assets that aren't multifamily for whatever reason, right? How would you guys advise, what should people be looking for when evaluating a DST sponsor?
I would say track record is really important, and track record both in terms of performance and also lack of bad actor type things. If you've ever been, as a sponsor, convicted of any sort of fraud or had a lot of lawsuits, that's a huge red flag. I would never put my own money with anyone like that. It's important to know that the people you're dealing with are quality, because while the investment may or may not work out, hopefully it does, you never want to have a situation where you're dealing with somebody that's doing something negative. And unfortunately, in the DST space, there are a couple of groups that have done things that I think have not exactly instilled confidence in different investors.
Mm-hmm.
So that's an important one. Another characteristic I'd say is, are they a group that is gigantic and needs to, quote unquote, feed the beast, right? You have a huge overhead and that forces you to do deals. One of the things that we pride ourselves in is that we don't have to do deals. We are lucky enough to have a diverse source of income, and we can be patient. As Mitch mentioned, we looked at 199 deals before we found the one that we bought last year. And that allowed us to buy a deal that ended up being very successful. Whereas other groups may have mandates where they put out deals every quarter, which inevitably means that you're buying in bad times because you need to create fees to pay for the overhead. And so I think a giant firm is a negative, also because you don't have access to the person who's putting the deal together. If I'm putting my money with somebody and I'm trusting them, I'm looking to them, and I'm looking to their team, but specifically them, the point of contact that got me in the first place. And if I'm dealing with a large firm, it's highly likely the individual telling you about the investment initially is unlikely to be there during the entire hold period, because they may be an executive or an individual who finds a better job somewhere. Whereas our firm is operated and owned by myself, my partner, we're the guarantors on the loan. We can't go anywhere, just point blank. We have our money in the deal. We have our reputation on the line. We have our guarantees on the loan. And so that means we're going to be available when we do the deal, during the hold if there's any issues, and then of course when we sell the property. So those are the factors that I would consider if I were looking at other sponsors, which I would encourage others to do.
Okay, definitely. And just so people get kind of a rough idea, how do you communicate with investors once they're invested into a DST?
Yeah, so carrier pigeon is actually, no, I'm just kidding. The primary avenue is every month we send an email to our investor letting them know that the distribution has been processed into their bank account. And every quarter we create a detailed investor report, which tells about the property, the financial performance versus what we said we were going to do, narrative about what's happening in the market, to the asset itself, and some statistics perhaps on some relevant factors. That is as a package that we email digitally to everybody every quarter. Of course, some people like hard copies, which we're happy to do as well, and that gets distributed every quarter. And then every year, typically in February, we distribute something called a grantor trust letter. And so unlike other tax documents, which you may be more familiar with, such as K-1s or 1099s, DSTs produce a grantor trust letter, which contains all the exact same relevant information for your tax preparer. And that gets distributed both via mail and digitally every February or early March if it's the first year. We also have an investor platform called Appfolio, which archives all of your investor docs, all of our investor communication with you, distribution history, and all of that information can be shared on a specific basis. If you have your attorney or CPA or your children that you want specific access to, view-only access or upload access, you could do that as well. And then, again, the most important thing is that we're open door, we're open book. We have our email and our phone number and our cell phone numbers on our business cards, should you have any questions.
Okay, sounds good. And I think one of my last questions is if you could share maybe just a little bit of Ideal Capital's philosophy in terms of investment. You had mentioned earlier it's more about capital preservation, not getting too aggressive. You can kind of speak on that a little bit.
Absolutely. So we recognize that we have the great privilege of handling people's capital. And usually in a DST, it comes in the form of somebody's largest or one of their largest assets. We recognize that that's a great burden on us. And so the key thing is setting expectations and also not losing money. Now it's investing, so you can lose money. That's absolutely the case. It's not a guarantee. However, what you can do is give yourself better odds than otherwise. And that means we're going to buy assets that we believe are in higher quality, more liquid markets. We're not going to over-lever them. That is, we're not going to take on excessive debt. The debt's going to be fixed rate. The properties are going to be nearly full, so 95% or so is the goal. And ultimately for us, it's preservation of capital and then the growth of the capital following that. And that stems from the fact that our firm, based here in Clovis, Fresno area, is trusted by so many individuals that we see every day. I can remember when we were raising money a while ago, I asked my grandma to invest, and at the time, she's since passed, but at the time she was 95, and she was interested in investing, so I told her about it, and she said, "Now I want to be sure this is a long-term investment, right? This not too short-term. I don't want to flip." And those are the type of interactions and people and investors that we deal with. There are our family, our friends, the people around us, and then of course many people that we don't know, but we treat the same way, or we hope to at least, because we recognize that trust is really what they're giving us. The capital is what they're handing over, but ultimately, it's a big deal to step from active ownership to a passive ownership, and that trust is important, which is why we're open book and transparent and always available.
That's right. Okay, perfect. So I think my last just question is if you could let whoever watches the content online or whatever, what would be the best way to get a hold of either you guys or the right person at the company who wants to potentially work with Ideal Capital, want to learn more about it? What would be the best way to connect with you guys?
Absolutely. So you can reach me directly. My email is Kevin, Kevin, at idealcapgroup.com. That's idealcapgroup.com. That's my personal email. Mitch is the same way. It's Mitch at idealcapgroup.com. Our website is idealcapgroup.com. And we also have our investor relations email, which is distributed more broadly to our team. That's IR, investor relations, at idealcapgroup.com. And so we welcome any conversation with anyone and happy to meet and discuss any questions.
All right, sounds great.